Hello and welcome to the MCF Institutional Education Series. The second quarter topic is Retirement Plan Basics. My name is Hunter Nybert. I am a financial consultant and retirement planning specialist with MCF. Who is MCF? We are your fiduciary consultant for your plan. We are an independently owned registered investment advisory firm. Currently we manage a little over $1.5 billion in assets and have offices in Lexington and just south of the river in Covington, Kentucky. In 2017, the Financial Times ranked MCF amongst the top registered investment advisory firms in the country, and we're real proud of that. Today, we're going to touch a bit on some retirement plan basics and talk briefly about your contributions, sources of income in retirement, suggested savings rates to meet your goals, asset allocation and diversification, as well as managed portfolio options in your plan. Now, just as a quick review, everybody knows that your deductions are automatically taken from your paycheck. In 2019, you were able to defer 100% of your salary up to a maximum of $19,000 per year. And if you are over the age of 50, you qualify for a catch-up contribution of an additional $6,000 for a grand total of $25,000. And always keep in mind that your deferrals are 100% vested and all the earnings and interest that they generate as well. Now, the purpose for saving in retirement, put simply, is to provide income for you in your retirement years. So let's take a look at where those sources might come from. A secure retirement may depend on several different income sources, which may include Social Security, personal savings, your qualified retirement plan, which would be a 401k or 403b that you're enrolled in, as well as other retirement accounts. Examples of that would be an IRA, or if you're enrolled in an ESOP through your company, or even maybe a deferred compensation package. The combined amount of these sources of retirement income should be about 80% in terms of what you're trying to replace your income pre-retirement. Let's look quickly into where this income may come from. A secure retirement may depend on several sources of income, which may include Social Security, personal savings, your qualified retirement plan, which is a 401k that you're enrolled in, or maybe a 403b, and other retirement accounts. Other retirement accounts include an IRA or an individual retirement account, or maybe your company offers an ESOP or a deferred compensation plan would be examples of those. The combined amount of these sources of retirement income should replace 80% of your income pre-retirement, and that's what you're making toward the end of your career. To maximize the likelihood of reaching this 80% income target, the suggested combined savings rate between your deferral and an employer match would be 12% or greater from the earliest age possible in one's career. If 12% is a big leap from where you're at today, consider increasing your contributions by a certain percentage each year. This may mean your next raise that you give an additional 1%. Or whatever number you can feel comfortable with at that point in time. And even a contribution rate of 1% each year can have a big impact of where you end up down the road. Just look at the difference between saving $200 and $300 per month when done consistently for years and earning and compounding is considered. That's a large difference. As your plan's fiduciary consultant, we will work with your employer's retirement plan committee in choosing a diverse selection of investment options that cover the full array of asset classes, such as stock funds and index options, both foreign and domestic, along with bonds and cash equivalents, which may include a stable value fund, which is a guaranteed interest rate, as well as alternative investment options. Examples of those might be diversifying strategies, real estate, commodity funds, things like that. For self-directed investors, this is a nice breakdown of the asset classes from higher risk to lower risk options, which are very important to be aware of when constructing a diversified portfolio of investments. Many people I speak with often think diversification is not putting all their money in one fund selection, in line of the thinking of don't put all your eggs in one basket, which is true. But generally, as a result, they pick different funds thinking that they are being more diversified, when in fact, more broad exposure to each asset class is the best way to achieve proper diversification. Each individual asset class has unique characteristics that spreads out exposure to any one single risk category and or market cycle. So it's very important to, when searching for diversification, to spread amongst asset classes and not just pick different funds. History shows us that we are better savers than investors. And this Dalbar study over a 10-year period is a good example of that, as broad-based indexes greatly outperform the average stock investors over that period of time. And I find it, in my opinion, that this gets greater as time goes on, even beyond 10-year periods. If you are wary of being a self-directed investor and managing your own retirement savings, your plan has managed asset allocation options such as target date retirement funds. This slide shows a typical glide path and allocation shift from left to right, from younger participants in pre-retirement to transitioning participants just before and in retirement years. The colors on the graph, red and yellow, are U.S. and international stocks, and the blues are bonds. Notice the allocation shift from stocks to bonds as one moves toward their target retirement date. So in other words, the younger in your career, you are going to be invested aggressively. And as you move towards that target retirement date, your risk shifts downward, as it should. Your plan may offer managed portfolio services that you could opt in or out at any time. The primary difference between this and a target date option is you get to choose your risk attitude and strategy immediately. So instead of being fully aggressive at one point in time in your earlier career, you could just choose a growth strategy as an example. You would also have access to a representative to discuss your personal account and situation individually. If you have questions about the availability of managed portfolios in your plan or specific differences, please contact MCF and our team will be glad to walk you through this. In conclusion, take advantage of the resources available through your company. Reach out to MCF for guidance or questions should you have any. Do the appropriate planning to maintain your goals. Those who fail to plan to fail. And we have to engage ourselves in this process in order to ensure that we are on the path for a successful savings and retirement. Avoid common mistakes that many investors make and remain disciplined to reach your goals. On my screen is my contact information. Feel free to reach out and email me at any time or pick up the phone and call us, and one of our institutional team members will help you in any way possible. If you found this information useful, I would encourage you to share it with other participants or people you might think could gain some knowledge from it. I look forward to doing this again or maybe talking to you all in the near future. See you next time.